All right, everyone, welcome back to Is the Bottom In? Today, we're diving deep into Carnival Corporation, ticker CCL. This stock has been doing that classic dance, consolidating between $28 and $32 for weeks, leaving many wondering, what's next? Is the bottom actually in for this cruise giant? We've done the heavy lifting, crunched the numbers, and I'm ready to spill the beans on our complete analysis. So, what's the buzz around Carnival right now? The market narrative is quite intriguing. We're seeing strong operational momentum, with CCL consistently hitting record revenues and yields for 8 straight quarters. EBITDA and operating income are at new highs, which is fantastic. Management themselves are painting a very positive picture. However, there's that elephant in the room, the Middle East conflict. While management says they haven't seen any discernible impact yet, this geopolitical risk is definitely a key watch point, keeping some investors on the sidelines. First, let's get you up to speed on Carnival Corporation and PLC. These folks are a leisure travel powerhouse. They operate a massive fleet of 87 ships, visiting around 700 ports worldwide, under famous brand names like Carnival Cruise Line, Princess Cruises, and Holland America Line, just to name a few. They even own hotels and rail cars. Talk about a comprehensive travel experience. Founded in 1972 and headquartered in Miami, they sell their cruises primarily through travel agents and their own websites. Management is projecting a very positive outlook, banking on continued demand recovery and strong commercial execution. Now, this is where the magic happens, folks. We take that market narrative, we compare it with Carnival's optimistic guidance, and we build out our scenarios to really see where this stock could be headed. The key takeaway here is that while CCL's operations are humming along, those external geopolitical risks are a real factor, and that's exactly what our scenario analysis helps us quantify. We've got 3 distinct paths here. First up, our base case, which we're giving a 50% probability. This scenario assumes Carnival continues its strong commercial execution and that demand for cruises remains robust, just as management is guiding. We're acknowledging the Middle East situation, but assuming it doesn't escalate to materially impact their operations or consumer sentiment. Think of it as the post-pandemic travel recovery narrative persisting. For our valuation, we start with their current diluted EPS of $1.84. We then project a conservative EPS growth rate of about 23.82% for the next year, reflecting that continued recovery and efficiency. That gets us to a projected EPS of $2.28. Then we apply a forward PE multiple of 18x. This is slightly above their current PE, showing some optimism for growth, but it's still reasonable given their strong metrics. And that, my friends, gives us a fair value of $41. Next, let's talk about our bull case, which we're assigning a 30% probability. This is our optimistic scenario, where things really kick into high gear. We're talking an accelerated recovery, perhaps a swift and peaceful resolution to geopolitical conflicts, which would boost consumer confidence even further for international travel. We'd also see Carnival exceed their current guidance, with even higher yields and margins, fueled by a robust global economy. To value this, we again start with that $1.84 diluted EPS. But this time, we project a higher EPS growth rate of 30% for the next year, reflecting exceptional demand and operational outperformance. That pushes our projected EPS to $2.39. We then apply a more optimistic forward PE multiple of 20x, justified by that accelerating growth and strong market sentiment. This brings our bull case fair value to a healthy $47.84. Finally, we have our bear case, and we're giving this a 20% probability. This is our pessimistic scenario, driven by external shocks. Imagine a significant escalation of the Middle East conflict, leading to widespread travel advisories, cancellations, and a general global economic recession that really hits discretionary spending. Higher fuel costs and operational expenses would also squeeze margins. While management isn't seeing an impact yet, this case assumes a rapid deterioration. For the numbers, we start with the 1.84 diluted EPS, but project a significantly reduced EPS growth rate of just 5% for the next year, reflecting those geopolitical and economic headwinds. That gives us a projected EPS of $1.93. Then we apply a much more conservative forward PE multiple of 12x, reflecting increased risk and dampened prospects. Our bear case fair value lands at $23.18. Now about those probabilities and how the technicals play a role. The stock has been consolidating between $28 and $32, signaling the market is waiting for a clear catalyst. Our 50% for the base case reflects the strong operational performance, providing a solid floor, making continued execution the most likely path if current conditions persist within that technical range. The 30% for the bull case acknowledges the significant upside if a positive catalyst emerges, pushing it above that $32 resistance. Conversely, the 20% for the bear case recognizes that while geopolitical risks are real, the fundamental momentum is strong, making a full breakdown below 28 support less probable, but still a possibility if a truly negative event unfolds. All right, let's pull up the chart and talk technicals. What I'm seeing here is a multi-week consolidation for CCL, bouncing right between that $28 and $32 range. It's like the stock is taking a breather, waiting for its next move. If we see a decisive break above that $32 consolidation, the next resistance levels we'd be watching closely are $33 and then $37. That would signal some real upward momentum. However, on the flip side, if price breaks down from this consolidation, we're looking at key support levels around $25 and then down to $23. So, is the bottom end for CCL? Based on our weighted scenario analysis, which factors in a 50% probability for our base case at $41, a 30% for the bull case at $47.84, and a 20% for the bear case at $23.18, our calculated fair value is approximately $39.50. This tells me that while those geopolitical risks are worth watching, the underlying operational strength and demand recovery for Carnival are significant. The current consolidation implies indecision, but our analysis leans positive. So, my verdict is, the bottom looks to be in, especially if global conditions remain stable and demand continues its robust trend. There's clear upside from current levels, though we need to respect those technical boundaries. Considering our analysis, if you are looking to start a position or add to one, I'd be looking for accumulation opportunities. The bear case gives us a potential support around $23.18, which would be a fantastic entry if any market turbulence pushes it there. However, given our more positive lean and the current consolidation, I'd also be interested in entries around the lower end of that $28-$32 range, perhaps closer to $28, or even slightly above, with the aim of riding it towards our $39.50 weighted average, and potentially higher towards the base case target of $41. All right, that's a wrap on our deep dive into Carnival. If you found this analysis helpful, you know the drill. Smash that like button, subscribe to the channel for more unbiased market insights. And let me know in the comments below, are you bullish or bearish on CCL? I love hearing your thoughts. Now, before you go making any moves, remember this isn't financial advice. I'm just sharing my analysis for educational purposes. Investing in the stock market carries inherent risks, and you could lose money. Always do your own due diligence. Consult with a qualified financial advisor and never invest more than you're willing to lose. Your capital is at risk.